The markets swing in record fashion. Absolutely blistering ranges for Wall Street, both yesterday and today. But ultimately, they don't go very far after gapping at the start of the week, as Asia Pacific markets take stock of last week's bloodletting in the wake of the new tariff announcement out of the Trump administration. So where do we go now? Well, the spotlight probably shifting for help to the Fed, and that's where we start the conversation here as the news begins to pour in about what the Fed might do next, and to feed the markets speculation about maybe, just maybe, getting a little bit of assistance amid all of this chaos. So let's just anchor ourselves here. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. We'll take a brief look first at what the markets are set up here looking like, because, of course, there's, at this point, a situation where we're looking at what is essentially a market that's still looking for answers, and last week's lead broadly still holds. So let's take a look here first at where last week left us. And we can see here, obviously, the bleeding is tremendous. S&P 500 down 9%, NASDAQ down almost 10%, huge shift lower in yields, expecting some kind of rate cut cycle to be closer at hand. Cyclical commodities marked by crude oil here, sharply lower. Copper's not on the tally, but its performance follows suit. Crude oil down over 10.5%. Even gold getting sold as liquidation comes for the markets. Euro and yen up a little bit against the dollar as that sharp shift in yields erodes the dollar's yield advantage. That's the baseline. That's where we start here. And with that, we start to then see that so far this week, we've tried to go lower, we've tried to go higher, we've ultimately ended up nowhere. This is a weekly chart of the S&P 500, and we see then that the markets aren't quite sure where this has landed, but they're not prepared to keep selling, it seems, at least beyond where the week has opened, even though the news flow has ostensibly not improved. In fact, nothing about positioning here suggests they've grown more confident, except that the backdrop has continued to deteriorate. Some more combative rhetoric out of the White House today, threatening still more tariffs on China. And the market has stopped falling, at least in the grand scheme of things. And it has stopped falling at an interesting and an auspicious spot. The top of the sell-off in 2022, the place that really was the level to break, defining this most recent rally from the lows in 2022 up through early December of last year, where this market topped. So this is, of course, a crucial inflection point. Whether you believe in technical analysis or you don't, all you really have to believe is that a majority of people that are participating in markets are looking at a chart of the S&P 500 and even just anecdotally say, oh, well, it's difficult to unsee that. And as long as they look at this as some kind of a point of significance, whether there is a bounce or a break, whatever point of significance, whatever this marks as an inflection zone is clearly recognizable. And as long as people act on that, it doesn't really matter if the level itself or the technical analysis implying it has any kind of validity or doesn't. If people do something on the basis that this is significant, well, then it's significant. If you break it and people start to sell more and the market follows through, well, it's self-fulfilling, but that doesn't much matter if it works. And if the market bounces here, it's the same kind of logic. And so we find ourselves at a real critical inflection point where the markets seemingly don't have conviction of direction and have to decide. Now, of course, the backdrop to all of this aggressive selling has been a dovish shift in monetary policy expectations as the markets basically conclude that no amount of market discipline is likely to get the White House off its square. And so perhaps the outlet, as typically the markets hope will be the case when fiscal policy is not giving them what they think is the right thing, is to turn to monetary policy and say, okay, well, the Fed will bail us out. And so as we've seen the fall in stock markets, so too the outlook for monetary policy has shifted in a meaningfully more dovish direction here. In the green is 2025's expectation in Fed funds futures. In the yellow is next year, 2026. And the orange line is the sum of the two. And we can see that we went from in early to mid-February about 50 basis points over 2 years to now 133 basis points, which breaks down to 4 rate cuts this year. We're within a basis point away, and at least 1 cut next year, and about almost 50-50 shot at a second one. We've gone a good ways of the way to up to that line. We're not quite looking at better than even odds of a second cut. Things have cooled off a little bit versus yesterday, but we're looking at least 5 cuts in the outlook here with option for a 6th. We can see the same thing in the path for policy expectations and where the easing is meant to arrive. So already we are flirting with the likelihood that a rate cut is all but priced in for May. And this is really a critical point here because the markets are seemingly setting up for a sense of urgency from the Fed to appear as soon as the very next meeting. So to have the cut all the way priced in, we would be looking at a 413 on that May reading because, of course, we're looking at a range here. 4.38 is the range middle between 4.25 and 4.5, which is where current Fed policy is. So we are at this point almost all the way priced in to a cut. We've baked in 19 out of 25 basis points. And so call it about a 76% chance at this stage that already next month we'll get the first cut. And of course, things cascade from there. We can see 4 cuts from 438 to 336 already on the menu by November, fully baked in. And then we start to edge lower still into the end of the year. With this in mind, the markets are going to pay very close attention to minutes from the March FOMC meeting that came out, or come out rather, over the next day. And of course, this is backward looking. Since then, we've had a Powell speech just in the wake of the jobs report on Friday. But this will be significant because the markets clearly are searching for an outlet and waiting to see if perhaps one emerges. And so what this will be is a useful stage setting for where the Federal Reserve's pain point might be. And if the markets can identify under which conditions it would start to become concerned, then it can layer that context against events that have transpired, of course, most critically last week, but really since that March 19th meeting, and then see how urgent stimulus might appear and whether expectations that it is almost certainly starting to happen by May, that is the easing cycle, then does that make sense? Should those expectations be in fact higher or maybe lower? Here's the statement from the monetary policy group here, the FOMC, from that March meeting. And really the key to take away here is this part right here. Uncertainty around the economic outlook has increased. That's sort of the key change here. And of course, since we get this, Powell then comes out at the press conference and offers what is essentially a we don't know next steps, so we have a balanced view until and as such. So here's a summary of sort of the key comments, and probably the biggest one here is we are not in any hurry to move rates. So to the extent that this describes the committee as a whole, we are now looking at perhaps exactly the kind of thing that the markets would like to see less of, but also this part of it is priced in. And so what the markets are going to attempt to do here, it seems, is try to tease out what it would take to get off this setting to something more dovish. We see that the Fed already expects that the tariffs tend to bring down growth, tend to bring inflation up. But of course, according to this, it's too soon to say if it would be appropriate to look through those effects. Now, that's an important qualification here, because what the Fed is saying is that whether it is appropriate to look through the tariff effects, that is, an upward lift on prices or not, will depend on whether the inflation will move quickly, and most importantly, will depend on whether inflation expectations are well anchored. This is an important sort of thing for the markets to look at, because if the Fed is saying we're not in a hurry because inflation expectations are well anchored, if they become unanchored, and which direction they become unanchored in, that would be a telltale sign. We see here, moreover, Powell says sentiment has fallen off, but the economy seems healthy. If soft data effectively becomes hard data, we will know very quickly. Of course, we've had a little bit of an example of this in the NFP report on Friday, which didn't come in badly, but the jobs part of the data flow is typically lagging. And instead, what the markets might focus on is something more timely. And of course, we have CPI this week, and that's already started to show some signs of rolling over. And so this is really what we're looking at here as the tone for these minutes. And of course, here was the summary of economic projections where the Fed adjusted the forecast to exactly what we've just described. So they lowered expectations for growth here from December to March, but kept the path of rates unchanged, basically saying, yes, inflation is likely to be higher, growth is likely to be lower, but we don't know how lasting all of it is, so the path of rates remain. Well, so what do we then learn in context? Inflation expectations have become unanchored, down, not up. And this is exactly the kind of nuance that we might want to hear from these FOMC minutes. The implication here clearly is that the market is concerned about growth to such an extent that it thinks that growth will overwhelm what is happening from what is essentially a tax increase. To the extent that a tariff is a sales tax on imports, basically, we have a situation where prices are likely to go up, hence what the Fed is saying here. But if what that does is then destroy demand to such an extent that there is a recession, well, then inflation goes down, because the absence of demand then drives down growth, and whatever uplift you have from the tariff is more than overwhelmed by a collapsing economy. And if we look at what's showing up here in the break-even rates, the inflation expectations implied in the bond market, is the market sees this situation not as an inflation scare, but as a growth scare. These break-even rates, the 5 and 10-year break-even rate, they're sharply lower, saying what the market sees is not stagflation, just a regular recession. And of course, yields in the dollar are down in tandem, despite some wild swings in the bond market at the start of this week. The same thing with the path of inflation and this question of hard data. Already since January, we're already seeing that the 3-month annualized and the 6-month annualized pace of headline inflation, as well as core, that part that the Fed really cares about, because, of course, it doesn't really have much agency over global energy and food prices, that they're edging down after this melting up over the course of the second half of last year, where very strong U.S. service sector growth created a lift. We seem to have already crested. And of course, this week, we're expecting to see CPI data that is going to show us, based on expectations, that the headline inflation rate came down to 2.6%, and that the core rate ticked down to 3% for the first time at the figure since 2021. And so, ostensibly, 3 points now make a convincing line. So if we're starting to see inflation cresting, and the market is saying inflation expectations are becoming dislodged, but it's down and not up, as long as the minutes broadly echo that these are the things the Fed needs to see to get out of wait-and-see mode, and now looking back in context, those things are occurring, one might then surmise that indeed the Fed is closer by its own measures, or at least probably a bit closer, to shifting to the dovish side of the spectrum. And then perhaps indeed rate cuts as soon as May, which is what, again, we're starting to look at here, that in fact that does make sense. Then, of course, comes the crucial question. If in fact that is what happens, do the markets find relief? We've, of course, seen that the markets are able to rally even in deep recessions, as long as the prospect of Fed assistance is on the menu. We saw this in spades, of course, during COVID, when the Fed announced, having learned its lessons from releasing stimulus in small doses and in defined ones, after the 2008 collapse, that this time they were going to say unlimited QE, and it'll work until we deem it done. Just the very saying of that helped the markets to find a bottom. And then ultimately, the provision of stimulus ended up being much more short-lived. Between March and August was really the extent of everything that needed to happen to convince the markets that the Fed would credibly prevent some sort of a credit seizing up situation. And sentiment bottomed right there. So if the markets walk away from these minutes with at least the sense that perhaps already next month the Fed will be prepared to ride to the rescue, a sense of relief might be the next step. And that need not mean that the recession isn't coming, and of course doesn't imply that whatsoever. There's nothing that the Fed can do or say on that kind of a time frame to spook GDP back into growth. Instead, what might happen is a bit of relief from the sentiment that has become so negative in markets, perhaps good for a bit of a bounce. But of course, then the question will become how durable is any bounce as that hard data that the Fed talks about starts to really show the degree to which recession might already be underway or is at least very close to gathering steam. And so while the bias here very much still is toward lower highs and lower lows, and so the trend appears down, markets don't move in straight lines, and you may, with the hope for Fed assistance, at least as cushioning against what is clearly a gathering economic headwind, to correct a bit higher, maybe somewhere in the 5,200 or 5,400 direction on the S&P, just as a loose reference, before the next leg down perhaps emerges. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go from there. I am likewise on with Chris for Futures Power Hour Mondays, and coming up on Friday, on with Victor Jones for The Price of Truth this week on Wednesday. Back with Victor and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Good luck.